Morning, guys.
Good morning, sir.
Good morning, sir.
Morning. Okay, guys, so let's begin today's session. This should probably be your last domain class before your soft skill session or anything is pending, if any, and then your final mocks that's expected to happen. Again, last mocks, most of you have not been able to do well, and that is again very disappointing. I think you guys just have one option left now. Start learning your answers, and that will take you and give you the confidence that is needed at this point of time. Okay, so that's the better way to do it. And practice as much as possible explaining your answers, standing in front of the mirror or recording yourself or telling each other. I mean, like 2 or 3 of you can group and you guys can explain the answers to each other. That will give you the confidence to speak. And it happens to all of us. See, even if I am talking about something new for the first time, right, I will also have jitters and I will also not be able to explain it. So the only way to do it is you learn a lot of things and then you write your answers or you pointers, etc., and then you start talking about those. That should really help you in your final marks, and it should take you to a better place in terms of at least getting tiered. Okay, some of you are on the borderline, so you guys will be able to get tiered eventually. However, people who have still not really prepared, I think needs to be really serious about it. Okay. So today we have regulatory, or not regulatory, we will have regulations as part of our session. Now, guys, I am sure we all understand the meaning of the word regulation, correct? Anyone here thought, what do they mean by regulation? What do you mean by regulation? Anyone, what do you mean by regulations? This has been your fundamental problem. You don't talk, and that is why you fail in almost all your mocks.
Sir, rules to be made. Rules made.
Rules made. Okay. All right. Anyone else?
Policy implemented for the safety of buyers and sellers.
Okay. Policies. Okay. Rules. Right. What else?
Policy making or law and order.
Okay. Law. Sorry. Come again.
Law and order.
Law and order. Right. Okay. Law and order. Well, okay. In financial services, law and order is not the word, but yeah. Okay. Anyone else? So can I say that regulations, who creates regulations?
Regulators.
Right? Regulatory bodies, regulators creates regulations. Regulatory bodies does it, right? And can I say the regulations are nothing but it's a working framework? It will basically give you a framework, right? Of what you can do, what you cannot do, how it needs to be done, etc., right? It's a framework, correct?
Yes, sir.
Right? Okay. Now, with this definition, what we are going to now do is we are going to understand few regulations that were brought in by US regulatory bodies and UK regulatory bodies, especially after the 2008 financial crisis. Any one of you know about 2008 financial crisis? Has anyone read about it? I know it's 13-year-old, 14-year-old phenomenon, but any idea anyone has?
So it was a real estate bubble that happened back in 2008 crisis. The mortgage-backed securities were sold to investors, whereas in America, they didn't check the credit score or the credibility of individuals, and they had issued a lot of loans. People took the loans, were unable to pay it back, but the banks tried to securitize these loans into mortgage-backed securities and sold it to investors. And again, the investors made a huge loss because the individuals couldn't pay it back.
Okay, all right, yeah, very close, very nice, good explanation.
And I want to add on one more thing. They also AIG was involved in this issue. AIG didn't know about what was a mortgage-backed securities, but still they got involved into it, and they also faced a lot of losses and consequences regarding the same issue.
Interesting. Okay, fair enough. I want all of you guys to go and read about the 2008 financial crisis. If you don't like reading, you can go to YouTube, and there are n number of documentaries and small videos or snippets that are available on 2008 financial crisis that one should know, and it will give you good clarity and understanding overall. Okay. But what we want to tell you, why I wanted to bring this here today, is because this is one thing that triggered a lot of changes in the regulatory industry. And one of them was Basel norms. These are all industries. This is a pretty theoretical class. So I'll write what I have to write, and you guys can let me know if you don't understand something. Now, please understand that Basel norm is not something, it was not something that was introduced in 2008. Basel norm has been there, which was regulating the commercial banks or the retail banks for quite some time. Okay. And one of the aspects of Basel norm was there are three Basel norms: Basel norm 1, Basel norm 2, and Basel norm 3. The Basel norm 1 that we have is right. This focused mostly on something called as CAR. Anyone has any idea what will be CAR in terms of financial services industry? What could be the full form of this term?
So in banking industry,
Yes, yes,
capital adequacy ratio.
right. Capital adequacy ratio, right? When we are talking about car, it's called capital adequacy ratio. Does it, Santosh, can you also tell what does it mean?
Uh, so like deposits and loans. I don't know, sir, exactly.
Okay. So every bank, their main business is to provide loans, correct? But it does not mean that whatever cash they have, they can go and give loan for the entire amount. Capital adequacy ratio tells the banks how much of the total cash that they have can be given as loan and how much of it needs to be maintained in order to meet any of their expenses or emergency requirements, right? Yes, Keshav, you have just joined. Why didn't you come for mocks, Keshav? Okay, right? So this capital adequacy ratio basically helps, or not helps, it determines how much a bank can lend. This is clear. Generally, 8 to 10% has to be maintained. Clear? Then came Basel Norm 2. Okay. Now Basel Norm 2 basically focused on credit risk. Now, credit risk is one important risk that most of the banks need to maintain. And this also was applicable to commercial banks 1 and 2. Until this point of time, investment banks were not really brought under the purview of Basel norms. Now, credit risk basically talks about how much loan you have given and what is the risk of it not coming back. Okay, so risk of default had to be assessed. This again was very focused on commercial banks. Then happened your 2008 financial crisis, right? And that triggered a lot of questions in terms of the ways how investment bank industry is generally functioning or was generally functioning. And that is where Basel Norm 3 came into existence. What Basel Norm 3 did was, it first of all brought all investment banks to follow Basel norms, which means now Basel Norm 1 and Basel Norm 2 will also has to be followed by the investment banks. And as part of Basel Norm 3, what was done was capital conservation was something that was introduced. Okay. Then leverage ratio was introduced. Okay. And liquidity ratio was introduced. These were the 3 new introductions apart from Basel Norm 1 and Basel Norm 2's actions that anyways all the banking system was expected to do. Okay, fine. Capital conservation is specifically focused. One of the reasons what happened in the 2008 crisis was banks were not worried about how much cash the bank has. They were not bothered about that. And because of which, what happened was, when there was a need and banks did not have enough cash to support their business, it led to their downfall. One second. Okay. Now, because of which, what happened was, most of the banks had to be bailed out with public money, and not everyone was happy about it. And which is why capital conservation was introduced. Then came leverage ratio. Now, leverage ratio is something which is to be determined by the trading world. Okay. Leverage basically means, if you have 100 rupees with you, what worth of things can you buy? If you have 100 rupees with you, if you are going in the market, worth of how much can you buy any item?
Worth of hundreds. 100.
Exactly. You can buy only worth of 100, correct? But sometimes you will notice that if you are in a local shop near your house and you have only 10 rupees or 100 rupees, and you can buy worth of 500 or 1000 rupees, and you will say, I'll pay you money tomorrow, or I will pay you by evening, etc. So that shopkeeper says, no problem, you take it and pay me. It happens, right? We all are equipped or exposed to this concept, correct?
Yes, sir.
What is that shopkeeper basically doing to you? That shopkeeper is basically providing leverage to you. With just 100 rupees in your pocket, you're able to buy something worth of 500 or 200 or 1000, whatever, it again depends. Similarly, in the world of trading, right? The world of trading, leverage comes into picture. So a trader might not really have $1 million in the account. It might only have, let's say, 500,000 in the account, but they find a good deal wherein the money is worth $1 million. So what it does is, what happens is, market provides certain leverage. They say, okay, fine, you can go ahead and book this trade for $1 million, even though you don't have it now, and you arrange the money in 2 days time or 1 day time, like something like that, they allow, correct? That's called leverage. Leverage is ability to spend more than what you actually hold, right? In market, generally, anything between 2x is what is considered good, 2 times generally. But during the crisis, what was found out was that leverage went up to as high as 5x, 7x, 8x, which means you are really letting yourself to be in a position where chances of your survival was not going to be happening, correct? And then third came liquidity ratio. Why liquidity ratio was brought into picture was, it allowed banks to measure, do they have enough cash, enough liquidity? Liquidity word is associated with cash mostly. Do they have enough liquidity available for them to be able to manage their business or day-to-day expenses? So this then came into existence, where there were expectations that you go ahead and do it on almost everyday basis. Well, it does not happen on daily basis, but what it happens is, it happens on a monthly basis, 6 monthly basis, yearly basis. You project based on today's trading positions, etc., how much liquid you will be. So but then what happened was, this was a regulatory requirement. Banks were expected to do, or else there will be a lot of, if you don't follow, what will happen?
Impose fines.
Right. You will have penalties, you will have fines, etc. So you have to follow. So Basel norm 1, 2, and 3 today is followed by all of the banking industry in US, irrespective of whether you're a commercial bank or an investment bank. Okay. After Basel norm, again, 2008 crisis, another thing came into existence was Dodd-Frank Act. This is another regulation that came into picture after 2008 crisis. And was passed as an act in 2010 in US. Okay. What was also noticed during the 2008 crisis was there were regulatory bodies. It is not that it was not there, but regulatory bodies lacked a lot of teeth. Sorry, they lacked a lot of teeth. When I say lacked a lot of teeth, means they were there, but they did not have excessive or enough powers to take action against any wrongdoing that they discover, or the industries that that were doing something not as per the right practice. They were not coming under the purview of the regulatory bodies, or they were not they were not providing enough reports, etc., because of which a lot of red flagging was getting skipped, right? So what was the intention of Dodd-Frank Act was? Its intention was to promote financial stability, of course, because that was one thing that was needed at that point of time, because if investors are not investing, markets would have collapsed. The second one was accountability. Yes, definitely. Right. And the third one was stability as an economy. Right. There was a concept, there was a jargon that was used, it was called too big to fail. Okay. These banks were so big as in not big in size, big in terms of the revenues, big in terms of the profit margins, that it was never expected that these banks can also collapse, because it was understood that they will have enough money to manage their expenses, their businesses, etc. But no one thought how they were doing their business. No one had that clarity. The reason they did not have that clarity was because the regulatory bodies which were existing were not having enough power, or were not having enough control over the functioning of the financial services industry as a whole. Correct. And hence what was brought into picture was regulatory bodies like CFTC, SEC, FDIC, etc., were brought together and were provided additional powers to regulate or demand anything which can bring financial instability, instability. Okay. For example, reporting with transactions done on daily basis. So every single transaction that was, any single transaction that was done by any of the banks had to be reported on daily basis. Okay. This one single activity, right, is a big thing in itself. And you have to do it today on everyday basis every bank who is operating out of US, irrespective of whether you are an American bank or not. If you have a presence in America, you have to follow these regulations. And you have to do regulatory filings and regulatory reportings on everyday basis. This came into power mostly because of the Dodd-Frank Act, which allowed these bodies to exercise its powers that it had, which it was not able to exercise initially. Any questions until now?
So the Basel norms and Dodd-Frank was introduced by the Americans or the UN?
Dodd-Frank Act was by America, not by UN. What will UN do? UN's job is not all these things. They are just a body which has been created to oversee things, but it's not that they can bring any regulations, etc. That's to the responsible, that's to the respective countries to bring in any regulations they want to.
Okay, sir.
The next one that came into picture was Volcker rule. Okay. Have you guys heard of the word proprietary before?
Yes.
What does it mean?
Something like ownership or running the business, like sole proprietorship.
Proprietary means our own. There was a concept called proprietary trading that was used very highly by the investment banks, which means, see, the concept that you have learned till now is there is a client who invests money and that money is managed by investment banks for making further investments, right? Yes, no.
Yes, sir.
However,
Yes, sir.
if a bank is making money for its clients, what stops it making money for themselves? They have their earnings, they have their money. So what investment banks started doing was they started using their own cash also for investment purposes to make money for themselves. And that was called proprietary trading. This business line was called proprietary trading business. Using banks' own money, there was no client involved here. Which means if a client is involved, then can you do anything that you want in client's account without their permission?
No, sir. We have to take a client's approval.
But if it is your own money, then whose permission you need?
Our own
No.
decisions.
You don't have to take permission from anyone, right? Which means you can take more risk.
Yes, sir.
Yes.
Yes, right? If there is a client involved, then you have to go as per the risk appetite of the client. But if there is no client involved itself, it is you who is using your own money. You can do whatever with it, right? That's the mindset all of us have. Right? And this is where what investment banks started doing was they started doing speculative trading. Right? Speculative trading began especially in derivatives world, which was considered a major risk that was identified during the 2008 crisis. And what Volcker rule did was it brought in the rule of limited prop trading. That was a word that was famous, prop trading, which means that banks cannot just go and use any money or every money they have for their own investment needs or for making speculation in the market. So because once your money is in the market, and if market has crashed, obviously you will not recover it, and now you don't have enough money to manage your expenses. And this was one of the biggest challenges that was identified during the crisis, and hence it limited prop trading and also regulated the use of derivatives market, which until then was very highly unregulated. There were regulations, but not major regulations. So these are the three major famous norms, regulatory regulations that are there in the industry: Basel norms, Dodd-Frank Act, Volcker Rule. You can talk about it in case somebody asks you in the interview, and these are pertaining to US market generally. Okay. Now, UK market also suffered during the 2008 fin crisis. And hence there were a lot of regulations brought by them also, and one of them was EMIR. EMIR is not what you call the kings, etc. in Middle East. EMIR is European Market Infra Regulations. Okay. See, derivatives as an industry, right, was found out to be a major player in creating downfalls, because mortgage-backed securities were structured products that were created, right? These structured products were then covered using CDS, which is credit default swaps. And when banks started collapsing, they started asking the CDS payouts to happen. And because of these CDS payouts, the biggest American insurance giant, AIG, was on the verge of filing bankruptcy, right? If that would have happened, almost every single American would have been out of any insurance that they had taken, because all insurance were generally taken by AIG as a group, right? Now imagine if that would have happened, it would have become a major challenge, which is where you saw Volcker Rule came into existence, right? Dodd-Frank came into existence. Similarly, in the Europe side, EMIR came into existence, right? This was brought in to stabilize the OTC derivative markets in European states. Okay. What it did was, it said all derivatives had to be done using an electronic trading platform. No verbal, no manual, nothing. Okay. This will automatically bring in clarity to what has been agreed, right? And cleared through CCP. What is CCP?
central clearing
Very
party.
close.
Central counterparty, which I think I told you during the settlements class, right? Clearing through central counterparty. London Clearing House is one of the famous central counterparties that we have.
Yes, sir.
The next one that came into picture was MiFID. Any idea of what is MiFID? I'm sure most of you would not have heard of it, but still asking. It's markets in financial instruments directive. Any idea what does it mean? You know, after the financial crisis happened, a lot of people who had invested money, okay, and I'm not talking only about people like you and me, like even the bigger clients, they lost money, right? So investors were scared, and hence to provide investor protection, this law came into picture. Because if, see, ultimately any industry runs when people start putting money, when people start investing, right? So to provide investor protection rule across whole of EU, European Union Economic Area. This is where MiFID came into picture, right? What it did was something very similar to what Dodd-Frank did, right? It allowed for increased transparency and regulatory disclosures. To take place. Again, something very similar, because reporting to regulatory bodies was of most critical importance and it had to be definitely done. Right? Okay. Then there was another regulation that came into picture. It was called FATCA. What is FATCA? We all know what is FATCA.
So Foreign Account Tax Compliance Act.
Right. What was it doing?
So like while open It's just like for US citizens, like to file annual reporting, sir, annual reports.
See, what was important was anyone, okay, okay, let's first understand the meaning of the word FATCA. It's not FATCA as it's called FATCA, Foreign Account Tax Compliance Act, as rightly said by Santosh. Okay, this was brought to evade offshore tax evasion. Okay, what used to happen was I taught you about hedge funds, and I told you about onshore and offshore funds, right? Side by side funds.
Yes, sir.
Okay, I know most of you wouldn't have remembered because you don't study only. So when you're in side by side fund, one is onshore fund, one is offshore fund. Now the problem with offshore fund is that people might invest money who are Americans as well in offshore and might evade taxes, right? Hence, it was responsibility wherein identification of accounts held by US nationals, or US taxpayer is a better word, and disclose it to US tax authorities. Otherwise, penalty of 30% will be charged, right? This was basically done to stop tax haven abuse. So these are the few things that we wanted to teach you on the regulatory side. It's important for you to know them. You don't have to really mug it up or anything, and don't have to also worry that it will always be asked. It's important for you to know, as part of this industry, some of the regulations that are there, because once you join, now we'll take a quick 5-minute break, and there is one last piece that we have to do. It's not to be done today, but I'll finish it off. It's called risk management. Okay, let's take a 5-minute break and we come back and we do risk management after this. Fine.
Okay, sir.
Thank you. So what is risk management? Any idea of what is risk management, guys? As per you, what do you understand?
It's identifying a risk and analyzing what is the risk and managing how to reduce the risk.
Okay. Anyone
Hi,
else?
sir. Risk management is basically estimating the risk which is going to occur in the future, and then planning accordingly to avoid, example, in the layman way, like bad debts. So for provision for bad debts is risk management.
Okay.
In the lines of investment banking, risk management mainly poses to client onboarding. So before client onboards, we evaluate the risk of the client in the base of risk, investment banking or commercial banking. We check the risk of the client that we are onboarding in we check the geographical risk, distribution channel risk, and we check also the industry risk, and it's one more risk we check about. So that's about my understanding. So
Okay.
and also product list risk. The products the bank provides to the
Tell
client.
me the difference between risk and uncertainty.
Risk can be avoided, but uncertain events cannot be avoided.
Okay. But both are being uncertain only, no? So what basis of what you can avoid a risk? Why do you say you can avoid a risk?
Risk can be planned to avoid. Like we can ascertain the amount of risk, but uncertainty is when it goes beyond our expectation, like which we cannot evade.
Okay. See, risk is a known unknown. Whereas an uncertainty is unknown unknown. Think little more about this, you will get a clarity. Again, this is not an English class, so we'll not focus on what is this. I'll give you a simple example. Anybody who is going on a road, what is a risk that we know?
Accident.
Right. You falling down, something hitting you, some form of accident might happen. But when will it happen? Do we know that?
No.
No, sir.
Right. So it's a risk we know that this might happen, but we don't know when it will happen. Right. Whereas an
Yes.
uncertainty is a situation like Corona, COVID. Did we ever think something like this will come?
No, sir.
Or do we know what might happen in next 3 months, 6 months, 1 year from now?
No, sir.
No, sir.
No.
Right. So that's uncertainty. We cannot control uncertainty. Okay, we'll have to face it as it comes. But risk can be managed. And in the world of financial industry also, risk has to be managed. Right?
Yes.
So ability to mitigate the impact of any risk is called risk management. Okay. What is risk management then? The first thing is identification or identify what could possibly go wrong, correct? That is what risk management is.
Yes, sir.
You have to find out, no, what could go wrong. Like when we are going on a road, we know that what could possibly go wrong. Then we will evaluate the impact of it if something goes wrong, what all might happen. And the third thing is, what will you do the third thing? Once you have identified, you have evaluated, what will you now do?
Try to mitigate it.
Exactly. So you will basically implement actions to address those risks, correct?
Yes, sir.
Any questions on these 3 steps? What are the types of risks you guys know then?
Low risk, medium risk, high risk.
No.
Market risk, liquidity risk.
Okay.
Tax risk.
Tax risk. Okay.
Credit risk.
Operational risk.
Okay. So we have various types of risks, right? Market risk is one of the most famous risks that we all keep hearing about. Then there is credit risk, liquidity risk, operational risk. Broadly classifying, there are 4 types of risks: market risk, credit risk, liquidity risk, operational risk, correct? What do you mean by market risk? Just a second. Right. Can you tell the types of market risks? Or what is a market risk, first of all? Risk of
Fluctuation in prices.
Price fluctuation. In the market. Right? For example, interest rate risk. Equity price risk.
Inflation risk.
FX. Inflation is a macroeconomic. We are not looking at that. We are specifically looking at industry wise what happens. Yes, but inflation is also a type of risk. So inflation risk will be covered under which risk here out of the one that I've written? What will be immediately impacted because of inflation?
Interest rate.
Exactly. The interest rate risk will get impacted. Right? Okay. What do you mean by credit risk? I wrote something above earlier in the session.
Risk of counterparty defaulting.
Yes. Risk of default. Very commonly in which market? Which instrument?
OTC market.
OTC derivative, not OTC market.
Derivative,
OTC derivative, it is very high, correct? So risk of default is also a type of risk. You might, if you don't get your money that you want, that you have, if that you're expected, or you have given someone some collateral and they are not returning that collateral to you, etc. So, those are the kind of risks. There are mitigating ways that are there. What is liquidity risk?
Deficit cash flow.
Funding risk. Not having enough cash, right? Now, please understand, as part of your role that you are going to get into, these three risks is not something that you will monitor. Neither you will have to manage. There are different teams who will be managing these risks. Like market risk is generally managed by the trading desk. Credit risk is generally managed by the credit team. Liquidity risk is managed by the treasury team. So there are different teams who will manage this. One risk that you will have to manage and you will be highly focused on is operational risk. I believe most of you are already working in this batch. So I'm sure you must be aware of some or the other form of operational risk you would have encountered in your day-to-day job. Even if you're not working now, you would have worked, then you would have understood what is an operational risk. Anyone wants to share what does an operational risk mean, or anything that they have come across?
So operation risk tends to any activity that disrupts business process.
Okay. Can you tell me any risk that you are aware of?
Example, employee errors, like human error, or
Employee errors, okay.
or any fraudulent activities.
Okay. Anyone else? Nobody has heard of operational risk. Okay. Risks occurring due to operational activities. For example, sending email to an incorrect recipient. How many of you have done this in your job? Missing to perform a task on a heavy workload day. How many of you have gone through this? Anyone who has been working? Fraudulent activities like transferring money to your own account in case you have authorization access. These are some of the famous or known risks that we all live with, right? But question is how to implement controls around these risks. Tell me.
Supervision.
Supervision, no. Well, it could be automating email that goes out. What do you call it? Macro, like by building macros, right? Checklists. Instead of this, I would want to say making incorrect payments or to a wrong account. Checklist allows you to not miss any items. You will have to sign at the end of the day. It will act as a reminder, correct? Making incorrect payment, it could be 4i or a 6i check. I here is eyes that we have, checks, right? These controls, these are some of the methods to control these risks. So people can actually talk to you, ask you during interview, what is a risk, right? Most of the banks do that. And people can ask you what is a risk that you're aware of. So do not only talk about market risk or credit risk, etc. They will also want to know, do you know what is the operational risk that are there, right? And another important aspect is escalation. Highlight that as well. So you can talk about these risks, like sometimes an email gets sent incorrectly to an incorrect recipient. So data breach takes place, right? Missing to perform a task, or sometimes a wrong payment can go to a different account if you have not typed in the account numbers correctly. Now, how do you overcome these type of risks? You can build macros by automating emails. You can have checklists having which highlights all the items that needs to be performed on a given day. You can have 4i 6i means 2 people or 3 people are checking the payment before it is going out. And of course, escalation by letting people know that some form of error has happened. These are some of the important methodologies of risk management implementation. And with this, we complete your topics. I would now open it for any questions or doubts you might have related to what we have discussed today. And then I will strongly recommend you guys to start studying, prepare your level 1, level 2, and get placed. Any questions or doubts?
So when can we expect the final marks?
I am not sure of that. Definitely, it could be next week only, no? Because everything is completed. You have any soft skills classes left? Your domain is done. So if it's not next week, then it will be week after, but it will definitely, you should start planning it with a mindset of next week itself.
Okay, sir.